YouTube, what is going on? What's going on, man? Good to see you guys. It is Wednesday, October 29th, man. Good old Fed day, man. FOMC rate decision day. Got my guys Top Step over in the corner, my boy Kevin. A lot of live streams going on right now. This is like it's like the Super Bowl for traders right now, so very exciting. As you know, I'm trading on Fed day, so I got a couple practice trades going. Got a couple calls in gold going, so I got gold on my left hand side, ES trade on my right hand side, based off the strategy. And yeah, man, waiting for a good old power to come out. Got about 4 minutes. It's about to get crazy. Yeah, we're here, guys. Good to see you, man. Taking a little break these last couple of days on YouTube. Did post a short from yesterday's trade on the ES breakout trade. Got smoked. Monday didn't take a trade. OG breakout day. So yeah, man, just been pretty light. Didn't trade Friday. Had a winning day Thursday, so everything's going pretty smooth, man. Just managing losses and sharpening the setup. Hope you guys are doing the same. Oh yeah, we're here. Kevin got the Fed bingo going, so we're about to get Kevin on the boards. We got rate decision information coming out momentarily, and we're here with you guys, man. If you trade, make sure you trade safe. I'll be right here with you. Let's go.
Here. Yeah, that was freaky. So the statement comes out in a few minutes there from Powell. Ready for that. But here's the IMF piece. Private credit alone. Banks are increasingly lending to private funds because they can deliver higher returns. Right. IMF report indicates banks are lending to NFBIs, which can then lend to, hedge funds, private credit, through the regulation, essentially, without properly accounting for, the risks to capital / falling collateral values. IMF calls, they literally say here, the results suggest that the impact on the bank's solvency ratios could be substantial. And it was the footnote. Where was the footnote? Is the footnote over here? I gotta get that Financial Times piece. The Financial Times piece was perfect on this. Financial Times. Bummer. I think I closed it. Oh well. Oh, wait. Yeah, no, this was where we talked about the Andrew Bailey. Right, okay. 4.5 trillion. Lending capacity, losses first, deposits safe. Yeah. Where there was another piece on this. We'll find it, but we'll go through the Fed and everything in a bit first. We just went through all of that. All right. We'll wait for the Fed statement now.
He's going to get his slew of questions from everyone, including Mike McKee. So the press conference will probably at least run 30 minutes or longer. He might get into the details on QT if they do announce QT. So
I found it. Okay. Yeah. So we'll go through more of that summary in a bit. But for right now, we're going to have the actual Fed piece come out. So this is actually a big moment because, first of all,
you are not prepared.
Yeah. But now we're going to get actual Fed decision. So this is going to go really fast, okay? I'm not going to be able to type it all out, but I'm going to read this all out as quickly as I can. I'm just going to put up the cues here. And I'm going to read this all out as quickly as I can. So buckle up, boys and girls. 15 seconds. Ready? Okay, Fed cuts overnight rate, 25 BP, says downside risk to employment rose in recent months. Available indicators indicate that economic activity expanded at a moderate pace. Job gains have slowed. Federal, consistent with these developments, economic uncertainty remains elevated. Inflation has moved up, remains somewhat elevated. Okay, attentive to risks of both sides of the dual mandate. The vote was 10-2, so 2 people wanted probably more. Myron wanted a half point. Oh no, Schmidt wanted no cut. 1 person wanted no cut. Fed to conclude balance sheet drawdown December 1st. Nailed it. QT ends December 1st. I told you it wouldn't be right away. I said within the next 60 days. Nailed it. Reinvest all mortgage-backed securities principal into treasury bills. Wait, so that means they're going to be buying. Oh.
Ooh, got the signal. Quantitative easing. Excuse me. Quantitative tightening. QT will be ending on December 1st, man. Been dealing with this for what, 3 years? That means the Fed will start back buying stocks, bro. This is gonna be good for the market. That's the signal that we needed for bullish momentum. Not gonna lie to you. Beautiful, beautiful. We're here, guys.
Said they'll roll over MBS payments into buying treasury bonds. That's not only ending QT December 1 and cutting 25 BP, but basically buying bonds like QE days. Holy bullish. Wow. Now that part was unexpected. So that's very interesting to me. So, okay. Let's listen in here.
This is very bullish information, guys. Very, very bullish. Check out that bid on gold. Gold's going crazy right now.
Job gains have slowed this year, the statement says, and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. They changed the tense on the balance of risks, noting...
Yeah, so again, QT to end DEAS-1, I guessed within 60 days. Nailed it. Okay, good. Then we have, obviously we got the 25 BP cut, minus 25 BP cut. That's not a surprise. And then we have the biggest surprise. I mean, this is like a huge surprise. Surprise. Fed will reinvest all mortgage-backed securities principal payments into treasury bills, aka so also known as aka they will buy treasury bonds just like they did during the QE days. So this is way more, which then makes you wonder, like, what are they concerned about, right? So like, how concerned are they about labor, right? Because think about what they're doing here. We're getting minus 25 BEP, we're getting QT and DEAS-1, and we're getting and QE on MBS rollover into treasuries. Okay? Like, I don't know about you, but it's somewhat kind of like, it almost sort of implies that they're like nervous or something, you know? So we also saw the decision was 10-2, but Schmid didn't want to cut at all. So that's interesting. 10-2 decision.
Whew. As you can see, guys, look at this price action. Practice trade just got stopped out. That's why I don't trade the Fed. Look at this practice account today. Got smoked. Bro still in the ES long. I guess he faded my stop loss, so he's probably somewhere a little lower in the volume. Gold's trading good. Like I said, I'm in some gold calls. They're about 30 days out, so as long as it's not puking today, I'm happy. And if it catch a bid, I'm even happier, man. But yeah, so that's good. So we got the 25 BP basis cut. QT is ending. The surprise was that they're going to be taking the mortgage-backed loans and putting it into treasuries, so they're buying treasuries. So, like Kevin said, it seems like they're a little nervous about something, but I mean the Fed is always kind of cautious. But let's keep getting the information, man. The story's going to develop. We got Powell coming out to talk, soon. That was just the first press release, so we'll see, man. Nothing too crazy on the market right now. Nothing too crazy. As you can see, price is kind of in the same area. So looking good, man. Nice and chill. Nothing fell off a cliff. Yeah, we're here. Let's see what Kevin's saying.
The sus eyebrows are going up. But at least there's still a coupon link below for today.
Coupon linked below.
All available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed. The unemployment rate edged up but remains low. More recent indicators are consistent. Inflation has moved up, remains somewhat elevated on inflation. Committee seeks maximum employment and stable prices. Uncertainty remains elevated. In support, we're going to reduce 25 BP. Not a surprise. That's what we expected. And then here it is. The committee decided to conclude the reduction in aggregate securities holdings on DEES-1. Well, where's that mortgage comment about them reinvesting it into mortgages? I guess they don't say it here. And these were where the votes were. Oh, here we go. Decisions regarding monetary policy. Okay, here we go. Unanimously to lower... Okay, let's see. Part of the policy decisions... Well, it wasn't unanimous. It was 10-2. I'm a little confused by that. Effective... Okay, that's fine. Overnight rate, fine. Roll over from the treasuries maturing in October, November that exceeds $5 billion. Redeem treasury coupon securities up to this monthly cap and treasury bills. To the extent that coupon principal payments from less than the monthly payments. Roll over all principal payments from Federal Reserve holdings or treasuries. Reinvest the principal holdings from MBS into treasury security to match the maturity. I mean, that's QE, man. That's disguised QE as reinvesting. Have I mentioned that my startup house hack has changed its name to...
QE, quantitative easing, guys. Very bullish. Pay attention.
This video is not a solicitation, but we put our whole AI plan up here with AI notifications, the valuation wedge, the renovation wedge, selecting your markets. Like, it's a really cool product. If you want to invest, you can always check it out at reinvest.co. But I think it's funny because, like, at the same time, now the Fed is talking about reinvesting. I can't help but think about, my company, Reinvest. I'm wearing the shirt, Reinvest. Board of Governors voted to unanimously approve the decrease in rates. We saw that. Yeah, this is very interesting to me. This sort of disguised QE.
Into next year, even if you select a super dovish Fed chair, how hard would it be to get things your way?
It's a good point, John, because in practice, and I do it myself, the Volcker Fed, the Powell Fed, but it is a committee. It requires votes of the Federal Open Market Committee. Oftentimes inside the building, the power of the chair is the power of persuasion. We've had some pretty persuasive Fed chairs, but there have been dissents. I think the key thing that we might start to see more of is dissents by governors. In the last 30 or 40 years, dissents really since Greenspan have been typically concentrated among the Reserve Bank presidents, and so that could also become a factor as well for the new Fed chair.
Rich, let's spend some time on this news conference. I imagine there'll be questions about what is guiding this interest rate decision, and for that matter, to Tom's point, what will guide the next one? Let's assume the government shut down. Rich, what is the data they can point to right now they're going to be leaning on, and how do they really flesh out their reaction function to non-traditional indicators? I think we're all familiar with how they respond to, say, non-farm payrolls, the unemployment rate, and CPI. But if you don't have that anymore, Rich, how do you communicate?
Well, it's tougher. You know, there are alternative sources, ADP for employment and,
Yeah.
you know, the Billion Prices Project for prices. But I would agree, John, the further this goes on, the trickier it gets really to make an affirmative case, especially right now. Let's be honest, you know, the justification here in September and now is really a risk management consideration. And, you know, but let's be honest, that goes both ways. There's downside risk to the labor market, but there's potentially upside risk to employment. So risk management becomes trickier as well with little data.
Where are you seeing upside risk to employment? You're smoking crack, homie. Where is the upside risk to employment? Show me where all of a sudden employment's gonna skyrocket. There's no upside risk to employment. Smoke another one, man. That is the dumbest thing I've heard. Upside risk to employment. That's upside risk to inflation, you knucklehead. Anyway, going back to this IMF report, which is bad. We have lenders with non-bank exposures worth more than their capital reserves now equal 40% of bank assets. That's from the FT, you know, from the Financial Times piece here. And then banks are increasing the lending of private credit funds. We saw this. Private funds. Where were the other numbers? Because they had the like 1 in 5. IMF estimates stock market is 10% overvalued. But that's below the 20% overvalued seen from .com bubble. Okay. Yeah. For that $4.5 trillion represents 9% of total loan books. And then they argued, I'm pretty sure it was that, from memory, somewhere around 1 in 20 banks wouldn't have the capital to cover these, you know, these private loans going bad. I want to look at it because it's in here somewhere. Before, you know, Powell will be out shortly, but I want to say it was right here. So let's see here. Here we go. Here we go. A few could face liquidity pressures. Some banks could face liquidity pressures. 4% of U.S. banks would lack liquid assets to cover the outflows. I mean, we could write that data down. So if NFBI stress, 4% of banks couldn't cover outflows, you know, that's sort of like back to banking kind of crisis. Obviously, you know, presumably the bigger banks would be fine. Presumably, bigger banks fine, but per IMF report itself, the bigger banks have the greatest exposure dollar-wise to these private loans, you know, these private credit issues. And so then it just becomes sort of a liquidity crisis. Bank stress shows that about 1%, let's see here, Silicon Valley stress test showed that global banks could incur valuation losses of 1%, CAT ratio 300 basis points fine. However, losses are much more meaningful for North American banks. Let's see here. Declines would be worse than stress tests. Yeah, we saw that. Okay. Here we go. 90% of lending to these immediate intermediaries comes from large banks. Okay. 90% of the intermediary lending and NBFIs comes from large banks. And so basically it's a way to kind of get around regulation. IMO, the private credit bubble, is a way for big banks to get around regulation and capital requirements. Yeah, the results suggest the impact on bank solvency ratios could be substantial, especially because of falling collateral values. This is an interesting warning here from the IMF. U.S. banks with high NBFI exposure are more fragile than their low exposure peers, especially exposed to falling collateral values. Yeah, this is a great piece by the IMF. And it's really just sort of like writing the book. It's writing the textbook page of this private credit kind of bubble that we're in. The IMF is writing the textbook for the private credit bubble we're in. Powell's going to be out in 15 minutes, by the way. And then, of course, we've got our Fed bingo board already cooking. So Fed bingo board is ready. All this stuff I'm writing down, by the way, about the IMF and everything, if you want to see that very neatly put together, you could always kind of look at my data. Just download the Meet Kevin app. You could do it on an iPad, iPhone, Android, doesn't matter. Download the Meet Kevin app. The data tab, it's totally free. There's no cost for it. The daily wealth tab, totally free. There's no price, nothing on it. And you could see like the screenshots I put in here, the highlighting I do, the comments that I make on Powell. We've already got the Atlanta Fed GDP, that rise in the blue chip consensus in here, the actual Fed decision. I've already written those notes in here. So you can see that all in the Meet Kevin app, which I think is very convenient. And then, of course, course members can get the trade alerts, the 10-year stocks to buy on the alpha report, the technical analysis, the fundamental analysis. The stocks have, like, we did a big fundamental analysis on Enphase this morning, a big landmine in Enphase's earnings call, by the way. We did a fundamental analysis on NEO, and we do them on, other companies, whether it's NVIDIA or Tesla as well. So very, very useful app. We put it all in that app too, because sometimes I see y'all complain in the chat. You're like, hey, I didn't get notifications that you were live for the Fed day or whatever. YouTube will only send you 3 notifications max in 24 hours. So in 24 hours, if I post 6 videos and number 5 is Kevin's live on the Fed, you won't get that notification. Even if you have the button all notifications turned on, you won't get it. But you can if the Meet Kevin app. You could customize which notifications you want in there too.
As well, and the ecosystems and entire communities in which they live. And now 1 in 4 children, you're talking about losing.
All right, guys, got stopped out the first practice trade. FOMC rate decision just came out, so got the NQ happens to be at the spread 4-hour long location. So we're about to put on a nice practice here, see if it's gonna hold for the Fed. You feel me? Yeah, can I even afford it still? 250 points, 200. All right, yeah.
Order filled.
What the fuck is that? I don't know what that was. Gotta check my book. I'm not live with it. Buy 5 and then
Order filled.
Alright. Buy 5 MQ, stop under SL 4-hour, which is under previous day's high as well. Alright, what's Tuesday high NQ?
1 second. Tuesday high is 26,239.
Alright, perfect. Alright, that's why I'm in at 26,252.
26,237.
What?
Yeah, I brought up this book already.
That's perfect. SL 4-hour chart, key level correlates with Tuesday high, previous day high, retest longs. Enter with 5 for the 50-point stop. Market shows me it's going my way. I'll pyramid into the position. Perfect practice, perfect. Let's see what the Fed does to this one. The ES trade, I have been holding that ES trade for like 2 hours off the 4-hour signal. So, and it got stopped out as soon as the Fed came out. So we'll see what the Fed does to this one. That's the thing about trading on Fed days. That's why it's good practice days, because like it just lowers the probability. It's not like a good thing or a bad thing. It just kind of lowers the probability of a setup. But all right, yep. Let's watch the trade go. Got Kevin Powell's coming out in about 15 minutes or maybe 10 minutes now, right?
Yeah,
About 10 minutes. All right, we're here, guys.
And then statements. We even drew the support line at $1. We called the top on Beyond Meat between $6 and $8. It topped out at $7.60. That was in the Alpha report. Remember, you can get that at meetkevin.com. You pay once, get a tax write. Hopefully, talk to your CPA, and then you never pay again for the Alpha report, which is awesome. Fiserv keeps selling off, down 43%, now even lower than COVID lows, which is not great for that financial plumbing. And I think that's why you're seeing some continuous pain in some of those restaurant stocks as well, where there's a lot of exposure for Fiserv transactions. NVIDIA keeps booming, still up 3%. We've got MP Materials still down 36% from our top call in the Alpha report. Dude, that freaking nailed it, man. That call nailed it. Symbotic, you know, another one we've been bullish on since $20. It's now at $72. Insane. Dude, how's it up 6% today? It's kind of remarkable. Q's nervous, though. Everybody owl.
This is how the markets want things to go.
Right.
So you're the market's representative and not the central bank representative like Richard Fisher is. What exactly is your response?
I'm happy to change places with you.
No, I'm sure you are, Richard. I know you are, Richard. So, Steve, let's respond to Richard right now. Given what you said, then how he responded, what exactly is the market reconciliation with the economy and some of the pros and cons that we've seen in the absence of government data?
Right. So first, let me start off with, I always love hearing Richard's comments. I always value those. That's why he's on the network, and that's why he's been around for so long. So if you look at...
This is a reference to Richard Clarita, who now works at PIMCO, used to work at the Fed, right? Powell's going to be out in 7 minutes.
They would rather have lower, because they rely on that variable rate fluctuation, so they need lower rates in order to hire more. So I think we have to make sure...
Dude, it's going to take so long for rates to show up. Shout out to those of you who just joined the Alpha Report. Christopher, Roderick, what's up? They literally just joined within the last few minutes. Welcome aboard. And then, of course, everybody else here. Chris, Jeremiah, Santiago, Travis, Mark, Robert, Boris. Welcome aboard.
So that's been locked up for so many years now. And that golden rate that many feel it's a golden rate is 5.5% on a 30-year fixed mortgage. We saw this during COVID. People didn't buy up as much real estate as they probably wanted to, but they did refinance a lot, and they refinanced around 3%. So we have a huge percentage that are locked in their homes. Yep. If we can lower those rates. Now, this is where it comes in to tie it all in. If you stop QT and you stop the $35 billion of MBS per month rolling off the balance sheet, that has the single most upward bias on 10-year yields. So if you stop that, which they are, that gives the ability for that mortgage rate to drop, hopefully precipitously. I don't know if it will be as quick as homeowners would like it to drop.
It ain't going to be precipitous. Not unless the labor market falls off a cliff, which could happen.
A very tight labor market that we had in previous years, which motivated businesses to undertake CapEx. We are going to see are actually further in the future. But this stronger productivity story for the Fed, I think, is one which suggests that rates most likely should stay higher over a longer period of time, and that our star is eventually going to be higher as well.
Michael Ferroli will write on this on Friday. You have to think about it and in the door. Another company, we're showing 14,000 a door, and on and on and on. How do you, with all your experience, treat
that it's the economic reality? You accept that we're in the very early stages. You hope that new industries and businesses will be created off of the back of AI that will employ more workers.
That's going to take forever to happen, Mr. Bob Michel.
Replace manual spreadsheets. We saw
2 first names. What is this? So you can identify as a woman half the time?
hope? He said just what Bob Michael said. It's one big academic hope by the haves that there's a good...
It's spelled Michelle. How is it Michael?
I think it's been absolutely brilliant on this. This is regressive up front. Can hold back employment. In the near term, I hope that changes. It can boost energy prices. Electricity in this country is becoming the political topic.
Agreed.
For the next
Strongly
18 months.
agreed.
Now, the argument you've got to make is that's all going to change. Productivity picks up. Great. If you strip out what is happening, say, with energy prices, electricity taking off, if you look at what's happening with labour market, holding back employment, isn't that a bit of a problem for this committee?
I don't think so. I think
somebody just donated $10 to say hit like all. Aw, thank you.
There's a problem.
Oh, no doubt. They've done that for 5 years.
But if there's...
Somebody else is talking about Michael Obama.
In and of itself will hold back some inflation.
We have 25,000 employees. You are the most qualified one I know to talk about electric bills.
Somebody's asking, why is the market melting? I mean, I don't think the market's melting. The Qs are fine. You know, this is just, you're basically flat. I mean, you're at 27 basis points. It's not a melt. But, you know, people are now... right now you're sitting at a 92% chance of a December cut. That's down about 6 points. So you're kind of seeing like, you might end up getting a Powell here that's kind of like, all right, boys, we gave you a rate cut and we gave you some disguised QE, some easing, some stimulus. Now we're going to wait and see. We might get some wait and see here. We're about 3 minutes away here from Powie Wowie. Woo!
Matt Lazzetti at Deutsche Bank. Matt, thank you, sir. Always good to hear from you. Matt Lazzetti there.
Johnny Blade says, like meet Jose. Cheers, buddy. Actually, you know what? I have Jose's favorite drink. Check this out. Hashtag not sponsored. Wish it was. Look at that. Oh, yeah, look at that. Oh, yeah. Topo Chico, straight from Mexico. Dude, Mexican food is great. And the water is very good, too.
What are the metrics? If we don't have the data, let's say the government's still shut down. What's
I
the
want
next
a
decision
burrito.
from John?
I think it's going to be anecdotal evidence from businesses. If they're still in a pause, hire, and fire, doing neither, then this Fed will respond by cutting rates 25 basis points.
What is your shop's 12-month call on 10-year yield? We're now, I'm going to say a 399, 398. John's in charge of that. I just look at the Dow Jones Industrial Average. John looks at all the rest of the data. But on the 10-year yield at a 399, what's your call 12 months out?
Well, let's start with Fed funds. We see that around 3 3/8%. I think you're going to see the 10-year somewhere around 3 3/4%.
Okay.
Bob Michael, JP Morgan, this was...
Dude, I got to get this soundboard.
Actually hit the economy. The markets react almost instantaneously, right or wrong. But I thought that was a very good point. And we're just going to have to see how he handles himself here and what he says. And I expect him.
Is he going to be on time? Of course he's going to be on time, because it's going to be the first part of our bingo board. He usually comes out about 30 seconds in. So we got about 30 seconds before he comes out. And I got my pen ready to mark him. To mark this off. Because it's my freebie on the bingo board. I am ready. Are you ready?
Bullish catalyst.
You are not prepared.
Taking the podium as we speak.
Good afternoon. Say it.
Good afternoon.
Yes!
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point.
You did more than that.
We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate.
Order
With
filled.
downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data.
I don't know if you guys have seen that. Equity just fell off a cliff. Oh. Equities just fell off a cliff, boys. Hold up, got a phone call. What that there?
Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition.
Stock's falling because he said go get the coupon code at meetkevin.com, expiring tonight.
Has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Are you uncomfortable with how market pricing has assumed a rate cut as a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the
This is him hawking because he's kind of bullish the economy. It's just a weird balance.
Some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and waited to gather more information?
So the way we have been thinking, I've been thinking about it is the risks to the two goals, for a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and it suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then,
Look at that.
then you ought to be at neutral.
Dude, I predicted 4.05. Wow.
To cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any?
I need to go vomit.
Instance of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's.
All right, guys. As you can see, the market is puking. Kevin just went to vomit. Market's falling. Stocks are falling. He pretty much just said that the cut in December is not concluded, so not a foregone conclusion in his words. So pretty much saying it's not set in stone that it's going to happen. Obviously, the market's already priced that in, that cut will be happening. So pullback like this on a day like this, it's there. Gold pulling back. Nasdaq just back at previous day high, so it's nothing really even crazy. You know what I'm saying? But yeah, it's pretty much what's happening. Kind of got to unprice that third cut. I'm not saying that it won't happen, but that's what the market is going to try to do. It's going to try to anticipate the next move and go ahead and price it in. And if that third cut would have, you know what I'm saying, if he would have said definitely the third cut was there, then market would have continued to go up. But that's kind of what I was kind of hawkish on today, a little bit bearish on today. If we priced in 3 cuts by December, and I've been trading Powell since I kind of started trading, I know he wasn't going to come out here and say, here's a cut and we got another cut for you. That wasn't going to happen. But let's tap in and see what he's saying, man. We're here with you guys.
Factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, you know, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, you know, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different.
Every time I opened that spreadsheet, my soul left my body. I had that too, but I switched to pipe drive.
And just to follow up on the balance sheet, if you stop the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing.
So as I promised before the Fed meeting, I executed our strategy. I sent a trade alert for those of you in the Alpha report. Remember, you get lifetime access if you're part of that at meetkevin.com.
You want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we'll expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just we think policy is still.
Market goes green again.
That's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press.
So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that the.
Let's go, Steve.
You're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run. It's longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
Yeah, totally
And then
agree.
just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others.
It's Adobe retail sales, not Adobe stock. Also, the odds of a December rate cut fell to just 74% now.
You're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Roy.
Alright, power question continues. As you guys can see, NASDAQ has bounced. Gold catching a bid. Bitcoin catching a bid as well. Yep. So market hit Monday high. Perfect retest on the NASDAQ. Bro, caught a couple nice setups on the NASDAQ. It's also looking at Bitcoin. But yeah, Powell said something good and market bounced. Good old Fed day trading, man. Let's see if NASDAQ can continue. Maybe bounce, make a new high. Let's see, guys. Powell's still going though. We're here.
Could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate in this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are. But that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward. Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth. That the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there's a sense like, from some, let's pause here, kind of thing. And a sense from others wanting to go ahead, but that's why I say differing views, strongly differing views.
Yeah, so on that division, then you're talking about going forward.
That pause right there, that's going to be bearish for the markets. You might feel like he did enough, and if he feels like that, December cut and January cut will be off the table. For real. December cut already down to 74% probability. I think it was at like 86% when the meeting started. So probability is dropping and the market's dropping with it. Yeah, we're here. Good old Powell.
People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Mike.
Michael Pickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. And you don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. Now, of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make.
Still here, guys. With Powell yapping. Market not doing much. Consolidating over Monday high. Still holding the bullish form. Gold kind of holding in the same area. Let me check my macro charts on gold real quick. Yeah, still holding a little micro uptrend that it's been on today. Did hit 4,040 on the futures end and came back down, so I'm still on a little uptrend. Yeah, so nothing crazy today, man. That little downside move got bitten up. Buyers took that opportunity to finally get that Monday high along, so that's always good with FOMC as well. Like, the practice on these days, like, usually the key levels hold. If you just wait for the extension move to happen, it's usually going to hit a key level, and then you can probably execute and make some bread. But like I said, I don't trade these days just because the probability is kind of low. You'll kind of end up with like a 50-50 win rate with like a high stress level for no reason. So, all right, good. Bitcoin moving, futures moving back up. Good, man. Wanted to go ahead and get that dip and bounce. We still got about 48 minutes left in the trading day. Got Meta, Microsoft, and Google earnings tonight as well. So a lot of information is coming out. Tomorrow we got Amazon and Apple. Yeah, man. So this is like the kickoff of some serious news. Once we get the earnings from our big tech companies, kind of get the backbone of how they've been performing, that's going to give a good outlook on the market, and we'll kind of see if we're going into Santa Claus rally going in November, December, or if we're going to be kind of halted. But as of now, based off what Powell's saying and how the market's holding up, little pullback, but still a bullish stance. So Santa Claus rally still in my book. We're here.
Much, even though consumer spending is strong.
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey, Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, so I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data, but if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies. And I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims, are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really
stable?
Any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that.
Stick around, by the way, and we'll be covering earnings. Microsoft, Meta, Chipotle, I'll cover them all today.
I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely.
Oh, here we go.
I'm curious how
Private
the
credit.
Fed is looking at these loan losses and
Go
if it
Yahoo.
poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining?
Inspired by a true story.
My name's Sarah.
You can call me Bert. A girl's ambition.
I can roll on my land. It's a sign.
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right, time to do a full summary. We're also going to be covering earnings, so stick around for earnings. But let's get our full Powell summary in.
All right, guys, that was Powell. As you can see, market reaction a little bit mild, kind of a pullback. Already about to eat this move back up. We'll pull back on gold. Pretty modest. We got the 25-point basis cut. The basis cut in December, the likelihood of it being a basis cut in December, another 25-point basis cut. Went down a little bit, but still possible. We just said it wasn't conclusive, but not completely off the table. I think it's like a 74% chance. And that's pretty much it, man, for me as far as my analysis. But we're gonna let Kevin break this down, see what he says. But yeah, 25-point basis cut, likelihood of a cut in December went down a little bit. And the end of quantitative tightening as well. That's a bullish consensus as well. So that's great. So it's looking good, man. Market's recovering from its little dip. The money printing should start again December 1st. That'll be good for stocks, small business owners, everything, man. So it's looking good. Let's see what Kevin has to say.
That is left over from mortgage maturities on their mortgage bond securities, MBS portfolio, and they're going to buy treasury bills with that, which is not as bullish or stimulative as them going and printing money and buying every duration of treasury bond, but it is a way of them reinvesting money into the economy. So it's what I call in disguise stimulus. So Powell's trying to put on this hard face of going, everything's fine. We haven't seen any real bad news yet, but they're really worried that the labor market could fall off a cliff. They're just not seeing it yet, which is exactly what we expected that the Federal Reserve would talk about. That the Federal Reserve would end up coming out, Powell would end up telling us, hey, we'll end up we're gonna look what we wrote. We literally wrote that he would downplay private credit risks. Guess what he did? We ended up getting a downplay of credit risks. Labor at break-evens, he told us the break-even rate is basically zero. And what's the labor rate right now at with ADP reads? About 14,000. So that's essentially why we got the 10-year Treasury to 4.05. Not a surprise at all. Now, what did we get from Powell that's broadly bullish for this market? And why did I send out a buy the dip alert in the middle of the presser and in alignment with our plans in the Meet Kevin report? Because, well, frankly, Powell was broadly bullish, and this is exactly the MO of basically what happens every single Fed meeting. People get nervous before Powell comes out, they get nervous while he's talking, and they get bullish afterwards. That's why I sent the alerts I did, and remember, in case you want those alerts all the time, get that Meet Kevin membership. All 8 courses, potentially a tax write-off, every trade alert, the top 10 stocks to buy, every alpha report every morning. Use that coupon code SchumerSiesta. It expires tonight. We'll be raising the price.
Coupon linked below.
So, with that said, what did we get specifically out of Powell today? Well, we actually got bingo. Barely. Right at the end, we got bingo. We got inflation outside of tariffs nominal. Yes, we already know that. In fact, he gave us a number. He thinks that inflation is sitting at about 2.3 to 2.4% outside of that one-timed longer-term effect of inflation from tariffs. Once those tariffs feed through, no more tariff inflation. Talks about housing inflation continuing to come down, which is really a bullish anchor for inflation continuing to come down. It's really hard to argue that inflation is going to a somehow second wave. And that's why I think over the next 10 years, well, probably 8 years from now, we'll see interest rates come down substantially over time. But no fall off a cliff on the labor market. And this is exactly what we saw in the ADP data that came out on Tuesday. This is why we talked about this. I even sent a special note to course members yesterday. I go, folks, that ADP report is going to have Powell go bullish on the economy today. Because the ADP report told us we're actually probably above break evens. Now, does that mean we might end up seeing the economy fall off a cliff with, a labor market that ends up driving substantially more layoffs, like we've seen with the announcements from Hewlett-Packard, Target, Walmart doesn't want to hire, Goldman doesn't want to hire, Amazon's laying off? Of course that could happen. But what did Powell tell us? He told us exactly what we thought he was going to say, that the labor market right now is in balance, and we're just not seeing that weakness show up in the labor market right now via unemployment claims or any kind of weekly data. That's one of the reasons why on our bingo sheet, I literally wrote stabilizing labor. And I wrote it twice over here. Break evens near zero. That was my prediction. That's what he said. We also wrote down stable, no cliff unemployment. We got all of those. We nailed all of those and got bingo across the bottom row there, which was great. Now, we didn't get a direct mention of the beverage curve, but he basically told us as much as what we needed to know regarding the components of it. So broadly, you got a bullish Powell here, an economically bullish Powell, and that's why one of the reasons during the meeting, we briefly saw the market sell off because Powell told us, hey, we don't know if we're going to have to cut in December. This is a way of Powell just being bullish about the market. In fact, right now, we only see a 67.9% chance of a cut in December. That plummeted from 92% chance before the meeting. We had a 92% chance of a rate cut in December before the meeting. That has now collapsed to just 67.9%. Now, he does say this could change, that layoffs are not in the initial claims yet, and they take time to show up, and that we're watching and monitoring these layoffs carefully. But right now, we're somewhere between 3 to 4%. Neutral is somewhere around here. We've already cut 150 basis points. There's no big reason to cut more now. This is why I said short-term bearish on mortgage plays and yields likely to go up after Powell. It's exactly what happened. It was in our playbook with course members in the Meet Kevin Alpha report. Now, Jerome Powell goes on to say that interest rates really don't affect data centers. And I hate this phrase, but he says this is different when he gets asked about AI spending today compared to the dot-com bubble. He says that in the dot-com bubble, we were spending money on ideas, and that today we are spending money on corporations with real earnings. And in fairness, if you compare back to Cisco, the earnings of Cisco were absolute trash in the dot-com bubble. And if you look at the earnings of NVIDIA with the margins that NVIDIA has, it's absolutely mind-blowing how different margins are today at companies like NVIDIA compared to Cisco back then. Now, does that mean we're not going to end up seeing a bubble? Not necessarily. At some point, the party will be over. But look at those margins at NVIDIA. A true financial analyst will look at these margins and go, holy smokes, that is the largest PP I have seen in my life.
Big PP.
56.4% on a chip designing company and a software company. NVIDIA doesn't even make the damn chips. They're just the freaking middleman. They come up with the designs, they send it to Taiwan Semi, and then they sell the chips directly to the end user. It's remarkable, and it's why they have so much freaking profit, and why I've raised my price target for NVIDIA for the near term. Now, do I think it's going to else did we get out of Powell? Well, we get, hey, that that next cut in December is not a foregone conclusion. It's far from a foregone conclusion. That's what tanked the odds of actually getting another rate cut in December. Now, part of that is because we ended up getting Schmidt suggest that we should not be cutting rates at all. Of course, Myron comes out, Donald Trump's shill bending the knee, although I've started to respect him a little bit. He comes out and says, hey, we need a 50 basis point cut. And so it's no surprise that you end up getting somebody else to counter that. So you get this, hey, we should have 50. You get somebody else going, we should have 0. We get 25. In my opinion, are we going to get 25 in December? Probably. We'll probably get 25 in December. Does Powell want to promise that now? No, of course not. But it's all going to come down to what we see in that weekly unemployment claims data, which right now we're not getting unemployment claims data because the government is shut down. So we'll wait and see when that actually comes up. That's why I say it's a bearish catalyst when the government actually reopens, because you're going to get that flood of data. Instead, you need to start coming to this channel every Tuesday freaking morning now. Why? Because what are you going to get Tuesday morning? Weekly ADP data. If you haven't been paying attention yet to the weekly ADP data, make sure you start paying attention. It comes out Tuesday. I also broke down the weekly ADP data in the data tab of the Meet Kevin app. So if you download the Meet Kevin app, you can see this data. I'll post it there pretty regularly. But here, as an example, on Tuesday, I posted the ADP announcement that the Fed was secretly getting this. Then they got rugged, probably because of Trump. Now they're just releasing it to everyone publicly. But anyway, 14,250 jobs. That's technically above the break even that Powell just forecast. So we would need to see a weakness to probably closer to 0 to really encourage more cuts. And so that's your forward-looking indicator now. Tuesday jobs data. We got to pay attention as every Tuesday now. And this is why, if you don't have it yet, download the Meet Kevin app. You get the data tab in Daily Wealth for free. Alpha Report and Stocks, that's obviously, for course members.
With a name like Biltmore, one would expect gracious hospitality.
One of my favorite parts of the job is to see people enjoy the end product of our labor. For me, hospitality.
If you want, you could learn more by going to reinvest.co or househack.com. It's the same company. Househack owns all of the AI technology. So if you're an investor in Househack, you're already in on this. You can always invest more if you wanted to. Go check out the offering circular. Go read about what we're doing. You could look at our real estate, the actual asset backed.
All right, guys. Gotta go ahead, sign out, man. Start getting ready for tomorrow. Good day with Powell, man. Nothing crazy. Price kind of stayed around the same area. Was pretty dovish. Got our 25-point basis cut. Also, pretty much a form of quantitative easing coming in. Yeah, man. December 1st, QT ending. What else we got?
We got bears. We're kind of talking about the horsepower confirmed December cut.
Yeah, the December cut. That's what I was about to say. Yeah. So the probability on the December cut down to 67% as of now. But of course, Powell kind of had to say that we might not need it because it's kind of bullish on the economy and the market. So it's kind of like a double entendre. So most likely probably going to get that cut, but him saying that we might not get it or it's not conclusive just kind of lends to his outlook of a bullish economy. So it's pretty good.
Depending on the jobs data, because these are coming off of the government shutdown.
Yeah. So
the government shutdown is bearish capitalist.
Yeah. Okay. So depending on jobs data, pretty much depending on jobs data, but the government shut down. So we're not getting the jobs data, obviously. So it's kind of hard to be data dependent, right? With it not coming out. So that kind of government being shut down still is kind of bearish. So whenever that opens up and we know we're going to be getting data again, that's going to be a bullish indicator. What else we got?
Yeah, kind of a bearish indicator. All the data is going to come out at once. So
yeah.
It's going to be bullish, but if it's shit,
then yeah.
Everything you did
when it was shut down. Got you. Yeah, so it could be bullish or bearish when the government opens up, so we'll get all the data that we've been missing. If it's not in line, all the work that we have done, pretty much all these new all-time highs and everything could be evaporated if it's not in line. Yeah, it would immediately take away the cut, obviously. Yeah. Yeah.
The jobs market is still not showing soft, which obviously it is. Amazon's dropping, everybody's dropping.
Yeah, jobs market's gonna be soft.
Yeah, so.
Yeah.
But
If it's not, then that's the risk that's on the table. Very true. Very true. Yep, we also got Meta, Microsoft, Google earnings tonight, so that's going to be a catalyst as well for the market. Crazy day on the video today. Kevin's pulling it up. I got it showing on the screen now. Trading at 208, new all-time highs on the video. Crazy move. Crazy move. But yeah, man, that's pretty much it. Sign out, get ready for tomorrow. I'll be here 9:30 tomorrow, live with you guys to finish out the week strong. Like I said, took a 1-hour loss yesterday, about a $500 loss in 2 accounts, and had no trade on Monday, so pretty much is down 1 hour for the week. So looking forward to coming in and finishing the week strong. Road to Live funding continues. Shout out my team, production, everything, man. Shout out you guys, all the viewers. Missed you guys in this couple days off. Nice to be back. Just looking forward to the Powell announcement. Gonna have a lot of good content coming out from all the information today. So just stay tuned on the shorts. We'll be breaking down all the information, so you guys are up to date. Probably start dropping those tomorrow after the live processes. But besides that, that's it, man. Great time with you guys. I'm about to get up out of here, man. My day moving, got some part-on stuff to pick up. Twin Peaks Trader merch is on the way. Stay on the lookout for that. Besides that, man, I love you guys. I'm out, man. I'll see y'all tomorrow. Trade safe. Respect your stop losses. Respect your mental health and your physical health. I'm up out of here, man. Peace.